Hello, everyone, and welcome to your weekly market recap. I am Catherine Murray. Well, we are certainly seeing markets struggle this week. Bit of a push and a pull, no doubt about that. We did see a bit of a down day yesterday in those U.S. markets with the S&P as well as the Nasdaq down by over 1%, with a lot of focus on technology stocks that have been weighing the broader sentiment. We are seeing a little bit better performance today as it relates to tech stocks in the United States, really led by Amazon on the back of their strong results. I'll get to that in just a second. But in focus for investors today, it's earnings results, rate outlook, and also, of course, geopolitics with increasing concern about an escalation in the Middle East, specifically on the back of Iranian-backed militias attacking U.S. personnel. So there is a real concern, of course, amongst strategists that we will see this broadening out of tensions in the Middle East. That, of course, is weighing on the broader sentiment of markets around the world. As it relates to what we're seeing in the U.S. markets, and then I'll get to the Canadian markets, PCE, personal consumption expenditure, did come in hotter than expected. That is leading investors to believe that perhaps we will see rates higher for longer. We are continuing to see inflation, in part driven by the price of oil, which has been moving higher. It's been down by about 4% on the week, but it is moving a little bit higher today, and is certainly more elevated than we've seen in the past. So PCE coming in a bit hotter than expected. That might lead the U.S. Federal Reserve to continue to be on the lookout for raising rates. Away from that, we're also watching investors digest the most recent earnings results. And as I said, a bit of a sell-off in some of those big tech names, in large part because of the guidance from whether it's tech companies or other industries. Is CEOs, company managements are concerned about the outlook. Obviously, less clear given the concerns about the economy, which we have noticed is slowing down, higher inflation, and the geopolitics are really leading investors to wonder about future earnings results and therefore what multiple to put on the stocks right now. So a lot of bearish talking points, there's no doubt about that. On the bullish side, I would say that investors are looking at some oversold conditions. Stepping back in terms of the earnings results that we've just received, Intel came in better than expected, so that stock's up by about 9%. Amazon had very strong margins, that stock's up by 8% today. Also, nice to see that Capital One within the financial sector also came in better than expected, so a positive there. And Deckers Outdoor within the consumer space also coming in better than expected. So some nice results that we've seen over the past day or so. But again, I think somewhat muted results in general from the earnings season that we've seen so far. And again, in large part because of the company management's outlook as it relates to guidance. Away from that, as we look at the Canadian market, the TSX is looking down today. That would be 7 straight days in a row of negative results. Canadian dollar is lower versus the US dollar, the worst level we've seen, in fact, since the March time period of this year. And of course, front and center for many Canadians, it was the Bank of Canada's decision this week. They, as expected, remained on hold at 5%. But it was almost a bit of a hawkish hold. In other words, they are leaving the door open for further rate hikes, noting, of course, that inflation looks to be a bit on the sticky side. That is leading some to believe that we might actually see stagflation in Canada. I've talked about this going back a year and a half ago. That means higher inflation and slow growth, which is very difficult for Canadians because it means your money just doesn't go as far. So the affordability crisis looks to continue under under that kind of situation. Away from that, there is earnings season here in Canada as well. One to point out, Chorus Entertainment, that stock's down by 26%. They decided to hold their dividend, pause their dividend, and instead use the money to pay down their debt. So again, that stock down quite significantly today. And I'd also just point out as well that we are seeing more job losses and job cuts within the Canadian financial system, which we really haven't seen for the past number of years, but so far about 6,000 jobs cut within that space. So a lot to keep our eyes on as it relates to the Canadian outlook and its slower, lower growth, and it looks as though these rates are still staying higher for longer. I'll leave it there, Julie. Have a great weekend. I have a great program coming up this Sunday and also next with Peter MacKay. I'll leave it there. Back to you.